Daily stock market update, everyone. US markets. Well, there's some respite for crypto. We'll come to that in a second. The other news story which has caught my eye on the wires from Bloomberg and from CNBC is SoftBank explained why they sold a load of NVIDIA, and it wasn't because of fears of a AI bubble. It was because they could make other AI bets. So that certainly suggests some more fuel for the AI rocket. Now, US close markets, what's the tone? Well, the risk appetite, we're still watching for US Open. It's the 2nd of December, and we've got about an hour before the American markets open. After this, I'm off to Canary Wharf in the city, and I'll see what the buzz on the street over there is. But it looks like it may well, looking at the futures markets, might well be a positive start. Every day, that's just noise. What we care about is longer term and seeing if the music is stopping, as they said in the film, margin calls. So the VIX, measure of volatility, slightly higher, but nothing to worry about. That usually is indicative of large swings and large moves. And looking at the economic data, nothing relevant coming out. It's all about interest rates. And so all economic data is being read in light of our interest rate cuts in December, likely by the US Central Bank. Two things which are moving markets: US interest rate forecasts and, well, NVIDIA, essentially, not even AI. The manufacturing index in the US slipped slightly. The data that comes out, the macroeconomic data, is so marginal and so small that it falls within a margin of error and becomes completely irrelevant. So the only time it becomes irrelevant is if there's a slew of data which all points in the same negative direction. There isn't, or any one of them is an outlier, and especially negative. There isn't. There's some suggested worries about layoffs in manufacturing, freezing hires, uncertainty about demand, but nothing which is going to affect our major portfolios. And I'll come to the portfolios in just a second. Crypto, bit of a drag today, might get a bit of a pause. It's 30% below its October peak. And so crypto exchange traded funds are getting a hit. So are stocks linked to crypto. I would want to see it drop 50% before I start getting excited about the drop and start buying into it in small amounts. A 30% drop is just regular volatility. You might say, well, why don't you buy in now? After all, a 30% drop means when it hits all-time highs, I've locked in a 50% gain. That's exactly correct. I'll wait. I could just double my existing position, which if I'd bought it at the peak of the market would mean that from now until it going back up to 50%, I've lowered the average price of purchase and I'm going to be in the money. But I think I'd rather wait for some more falls. Of the earnings coming out, none of them are going to move the markets. You've got CrowdStrike, Marvel. Marvel and CrowdStrike are fairly good companies. They're not in my portfolio at the moment, I don't believe. Pure Storage, Okta, GitLab, Box, American Eagle, none of those are going to be of any relevance for either the economy or for my pension, my investments. The FTSE 100 futures, again, suggests a quiet market, and indeed it has been a quiet market. The Bank of England Financial Stability Report came out. Oh my God, that's a good one to read. It flagged elevated global risks. They said there are concerns about geopolitical pressures. Well, tell me when that's not been the case. In 1974, my father, myself, a few family members went by road from the United Kingdom in a VW camper van to India. Took a month. Iran, Iraq, Afghanistan, Pakistan. You could do that in 74. There's been elevated geopolitical risks since that trip. I'm not saying I was the kiss of death or curse for global markets, but really the Bank of England pointing that out, irrelevant. They're worried about sovereign debt concerns, i.e. countries borrowing too much. Well, if interest rates remain low, they can fund those. It's not a problem. Latin America has a problem. Italy has a problem. They have a perennial problem. Again, nothing new. There's no outliers here. There's nothing which we're looking at in the horizon saying what could drag things down. All recessions happen because of three reasons. The P&L of companies, profit and loss accounts, i.e. the companies haven't got earnings, like dot-com bubble. Balance sheet worries, 2008 financial crisis, assets aren't worth what we thought they were, Liz Truss, spiking bond yields, government bonds weren't worth as much as we thought they were for a short while, and cash flow. Okay, COVID, close all the shops, no cash coming in. Three things that cause crashes. We're looking for those on the horizon. We haven't found them yet, okay? Bank of England's also warned that valuations in AI-related equities are stretched. Well, the Bank of England's job is not to be a stock picker. Near dot-com levels, they say. Okay, well, of course, they've got to say that because they were caught sleeping at the wheel during the financial crisis. So this time, everything looks like a horror show. And they believe there's risk of a sharp correction. Now, they're right on that. Statistically, there is a risk of a decline in the markets and it being sharp, i.e. the larger the fall over the shorter the time frame, the more likely it is to cause a panic. The reason we know that's the case is not because of valuations, it's because of statistics. Human nature being what it is, after prolonged periods of gains as we've had, there tends to be pullbacks. We know that from statistics. We don't need to try and read the crystal ball. So they're correct on that for the wrong reasons. It's like the Bank of England, isn't it? Right for the wrong reasons or wrong for a prolonged period of time for all the right reasons. UK European corporates reporting today, Future, Discover, i.e. Victrex, Foresight Group, New River. There's none of them which are important. Topps Tiles. If you want to really read too much into it, read Topps Tiles earnings report on that will give you an idea of demand in housing. Honestly, it's not that complicated. And you don't need to do all of that. So I'm going to turn to the news wires in terms of, well, what's good and bad news. NVIDIA backed an AI startup. They put $4 billion. There was a time when you backed a startup meant you put a few $100,000 into it. $4 billion. That startup is going to be hiring it's called Luma AI, hiring 200 people in the UK. Here's a trick if you're looking for a job. Just see who's getting the money. First thing they do with money is hire people, apply to them for a job. Okay, they'll be hiring everybody from new cooking staff to AI engineers. Now, that's one. I already told you about NVIDIA. That was an important story because he clarified why he was investing in the others. What else have we got which sort of catches the eye? And remember, no news is good news. So if we don't get such great news, it's fine. The biggest movers on the US markets, WR Berkeley, one that I do hold, it's down 6% today. Am I worried? No, because it's part of a portfolio and I look at things at the portfolio level, not the individual stock level. Synopsys, also one I own, it's up 4.85%, but it had some falls recently. Again, comes out in the wash. Think of it like this. There hasn't been a single year from when he started investing to when he became the world's richest man where Warren Buffett's portfolio had either the top 20 best performing stocks of that year in his portfolio or every single stock went up. Never had a year where either of those things were true. Here's an interesting story. Apple has named a former Microsoft and Google executive to succeed their retiring AI chief. Now, what's important about that, and it's really buried down in the wires, is what it tells you is what I've been saying for a long time. These big companies, Microsoft, Meta, Apple, Amazon, Alphabet, NVIDIA, I own all of them, have got so much money that the talent can only move between each of them because they're not going to get paid that kind of money anywhere else. Okay, rarely, occasionally, the number 4 at Google, old friend of mine, Nikesh Arora, moved to Palo Alto Networks as CEO. So rarely can they get a package outside of what those big names offer, or they get so rich they set up their own fund and family office. The point being, there is a monopoly on talent, and talent is what makes money. People think it's it's dug out of the ground. It isn't. We don't live in the oil age where you can have any oil head dig a hole and you get rich. No, we're in the tech age, which means it's talent, it's individuals. And those individuals are predominantly working for those companies. So that caught my eye. Crypto downturn wipes out almost 1 billion in levered bets. There's been a hell of a lot of people who've had leverage on Bitcoin. And the smaller moves down means they're getting wiped out, they're selling out. And so that's accentuating, it should be slowing down some of the falls as they buy back. But what's happening is it's just accentuating the volatility in the direction and causing panic as people who were just simply long selling out their positions. And it's not being replaced by others. Yet, it will at some point. There's enough crypto believers out there that it will at some point, just as there are enough people who believe in Santa Claus out there, that you will still get little boys sitting on Santa's knee every Christmas. The same thing with crypto, whether it's real or not, doesn't matter any more than in many ways it matters whether God is real or not. The believers believe in crypto just as they believe in modern art. And so it needs to drop a bit more before I'd get back into it and get that right. But like I said, from now to the all-time highs, which will happen again at some point, if you believe that, then you locked in a 50% gain from today's levels because it's down 33% from the all-time high. So all you've got to ask yourself is, can the all-time highs be reached again? And you might say, well, okay, well, 50%. What if it takes a year? Great. 50% annual return, phenomenal. 2 years, 25% per annum, not too bad. 3 years, 22.5%. 3 years, about 17% per annum. Not too bad. You're still a run rate of doubling your money in 5 years. What if it took 5 years? Then you might say, well, I don't think it's going to take 5 years. So you got to ask yourself, can it hit an all-time high in the next 3 years, in which case you're on a pretty good run rate with that investment. Okay, decision making is simplified if you can make your decisions either into a sliding scale or into binary. So those are the major issues. I'm not seeing, there's articles about US-China war. Ray Dalio has talked about various other worries he has about the world and AI and all of this. None of that's moving the markets. Michael Burry, the famous hedge fund manager, has set up a newsletter and he's saying AI is all overbought and all the rest of it. Well, he's given up the hedge fund business and gone into the newsletter writing business. I might tell you all you need to know about his ability to call it right. That's all positive. Now, I need you to do me a favor, as I always ask. We've got a new website. I'd like your opinion on it, campaignforamillion.com. It's been redesigned. It's actually a stopgap till we do a complete revamp, which is going to take another 2 months. But for the moment, it looks pretty good, campaignforamillion.com. I'd like you with these videos, if you like these daily updates, and I try to sprinkle what's happening with a bit of education, is please save them because the algorithm rewards me more, i.e. sends the video to more people. If more people watch it, I'll continue doing them. If I get more than 3,000 people a day watching it, then I will do more of them. To get 3,000 people a day watching it, I need you to either save, which is the most important thing because it pushes it to more people if you save. Comment is almost the least important, but I love hearing back from you. So that would be important, including your comments on campaignforamillion.com website, please. Okay, if you like, subscribe, repost to others, forward to others, that counts for a lot on the algorithms as well. Because if you think about it, YouTube and TikTok algorithms are based on what might other people like to see. And if you don't do anything, those algorithms are not telepathic. They need you to actually do something and say, yeah, I bloody like this. So if you share it to others or you save it, kept it for yourself, the algorithm says, well, actually, this person probably liked it and wants to do. So I'm trying to get you to act upon the fact that you actually did like this. A bit like one of those people at Covent Garden Market who says, look, if you enjoyed the show, here's a cap. Please put some money into it. You don't have to do that. I'm going to do these for free. If for free, you just like and save it. See, the death of capitalism, everything for free, including more people watching it. Isn't that a great business model? I continue doing these for free. You benefit for free. Thank you very much for all of that. If you'd like a free copy of this book, campaignforamillion.com. If you'd like a free internship, wherever you are in the world, campaignforamillion.com. If you'd like a free copy of my book, where I interviewed 10 of the world's leading fund managers, campaignforamillion.com. If you'd like a free educational pension review and report, yep, you guessed it, campaignforamillion.com. Thank you all very much. I really appreciate you. You've been the best audience I've ever had. Let me put it that way. Thanks, everyone. Thanks a lot.